Now the next section is liquidity. The current ratio is the current assets divided by current liabilities. And once you have it for 1, you can just drag it across. The working capital ratio, or working capital, is the current assets minus current liabilities. So one's a ratio, one's a dollar amount. And we're looking for these to be above 1 for sure, if not even higher than that. Then the solvency ratios. Debt to equity ratio is our total liabilities, debt, divided by total equity. Debt to asset is total liabilities, debt, divided by total assets. And our equity to asset ratio is total equity, net worth, divided by total assets. And then we can do a check, because if this is the portion of assets that are debt and the portion of assets that are owned, the two things together should add up to 1. So we just say 1 plus the other. And indeed it does here, so we've done it right. Once you've done it for one column, you can simply drag it across, and it does it for all the others. One thing to realize when we're doing these cost and market ones, the only thing that changed between these two columns was the denominator, what we divided them by. And this column should have larger assets, larger liabilities, larger equity, because it includes the equity from asset valuation and from operating your business, retained earnings. So these are divided by larger denominators, so they're always going to be smaller. And so depending on what you want to do, it's really good to kind of know both of the numbers, but realize that you can't compare market numbers from one operation to cost numbers from another, because they're not going to match up. Down here, your liquidity ratio, because current assets and current liabilities should be the same no matter how we valued our non-current assets, these numbers should be the same for cost and for market. Our solvency ratios, however, are dealing with total assets, which are different. And so the debt to equity ratio, if we're looking at a cost-based, then it's 2.23. But if we're looking at the market value, what those assets are worth now, it's 1.25. And so these, to look at our debt to equity, is probably more realistic to look at market value numbers. And we usually don't want our debt to be larger than our equity. So we'd like this debt to equity ratio to be no bigger than 1-to-1 or 1. And so here 1.25 says that we've got more debt than equity, and that's really not where we want to be. So this has a little bit too much debt. However, it's getting better, and so maybe they got into trouble a few years ago, and now we're working towards getting that debt more under control. So now coverage and repayment capacity ratios. Interest coverage ratio is really just talking about how many dollars, or how many times are the dollars that we have available to service debt, to make investments, is it covering our interest? And so it's simply R divided by our interest expense. And so we're making $2.2 for every dollar of interest that we owe. So as long as this is above 1, we should be able to have enough money to at least make interest payments on our debt. But that's really not good enough. So we want to know, well, really, how many dollars do we have available to service the debt or make investments? So this is our repayment capacity. And it's the net farm income from operations plus total non-farm income plus depreciation, because we subtracted depreciation from net farm income, but really we didn't, it's not a cash expense, so we have that cash available too, minus the income taxes minus withdrawals. And so in this case, we've got $85,000 here available to service our debt and to replace capital or make investments. And we want to see what kind of a margin that is compared to what our obligations are. So what we do is we take our replacement capacity plus our interest expense divided by our interest expense. This is how much plus our current principal payments. And so what this is doing is it's taking how much we have available to service debt divided by how much our debt service obligation is. And it says a 2 here means, and I'm going to add a couple more decimal places. And all I did is just this arrow increases our decimal places, decreases. And so for every dollar that we owe to the bank each year, we're earning 2.25 times that. And so so we've got a good margin there. And what I did is I calculated this, the wrong one on the wrong line. So that's our ratio. So for every dollar that we'd owe in debt, that's how much we're making. So our margin, or our replacement, capital replacement margin is our replacement capacity minus any old operating debt. And here's where this isn't really on my formula or on my form here. So if you had something where you have operating debt that you haven't paid off every single year, and in our case we did pay it all off, then you'd also subtract that off. Current principal payments, the $21,000, minus personal liability. And so if we have some extra personal liability, then we'd have to include that too. So in this case, we have $63,861 above what we would owe. And this represents 2.25 is for every dollar that we'd owe, we really have $2.25 available. So just two ways of looking at those. And then our value of farm production or gross revenue, you can do these financial efficiency ratios over both. So I'm going to show you how to do them for value of farm production, and then you can also do them for gross revenue. So our asset turnover ratio is the gross revenue or value of farm production divided by our average assets. So in this case, it's the value of farm production divided by my average assets for cost, and I can do it for market too. Value of farm production divided by my average assets. Then our operating expense ratio, depreciation expense ratio, interest expense ratio, and net farm income from operations. All of these are simply taking all of our different expenses and breaking them up in different ways, and then saying what portion of our revenue they are, because all these should add up to 100%. So the first thing we do is our operating expense ratio. So that's just our operating expenses. And there's our operating expenses. And we had depreciation included in those, so we want to subtract that away from it. And then we divide it by our value of farm production. The next one is our depreciation. Depreciation divided by value of farm production. And then we've got the interest expense ratio, which is our interest expense divided by value of farm production, 9.99. And then our net farm income from operations. It's our net farm income, where is it? Net farm income from operations divided by our value of farm production. And then we can say sum Don't include your asset turnover ratio. And those all add up to 100%, so we did it correctly. Over here for the gross revenue, there's a couple of things that need to be changed. Since I need my gross revenue too, and not just my value of farm production, let's come over to the income statement. Let me show you what we're dealing with. Here we were doing value of farm production for everything. But if I'm going to do gross revenue, I need this $304,374, this gross revenue. And also I have two expenses here, purchased feeder livestock and cost of purchased feed grain. Those two, they need to be added to these other farm operating expenses to get my total. And so I need to do just a few modifications over here if I want to do that. One is, and I'm just going to do it down here, I'm going to insert a row and insert another row. And I'm going to also see how my freeze panes now is above that, and I want to actually be able to see this. So I'm going to go under View, Unfreeze Panes, come down here where it is, and then say View Freeze Panes. And now as I move down, these two are going to show. And then what I want for this is gross revenue. And I want feed animals purchased. And so my gross revenue from my income statement is $304,374, and my feed and animals purchased is right here, my $81.99. So now I'm ready to do these formulas for gross revenue. So now for my cost-based, I'm taking my gross revenue and dividing it by my average assets. And I can do that for market-based too, divided by my average market-based assets. Few too many decimal places here, so go home, and then just click the arrow to get those all down to fewer. Okay, then my operating expense ratio. My operating expense ratio is my operating expenses divided by gross revenue, but I've got to, so opening parenthesis, so here we have our operating expenses. We want to subtract off depreciation, and that's what we did for value of farm production. But here's the little tricky thing, and this is usually how people miss it here, is for gross revenue, we need to include also the feed and those feeder animals purchased, and so we want to add that to it, and then divide it by our gross revenue. Make it a percentage, add a couple decimal places. And then our depreciation expense ratio is depreciation expense divided by gross revenue. Interest expense is interest expense divided by gross revenue. Enter. And then net farm income from operations is NFIO divided by gross revenue. And we can make these all percentages, add a couple decimal places, and then let's do our check. And if we've done things correctly, and we did, these both add up to 100%. Most of the mistake that I see here is students won't remember to add in those other expenses, and so you'll get something that doesn't quite add up to 100% here. And that's because we didn't include the feed and animals purchased. So there you go. So now we've completed how to calculate all your different ratios, and you're ready to go.